Morning, Keith. Good to see you.
Good to see you, Joe.
Awesome. If you're ready, we'll just jump right into the case here and get moving.
Let's do it.
So your client is Canyon Capital Partners, or CCP for short. CCP is a long-established hedge fund headquartered in Hartford, Connecticut. Hedge funds make money mainly out of management fees and carried interests. Over the past 2 years, CCP's profits have been declining. Its CEO and founder has hired you to help her understand why are profits trending down and what should she do to restore the firm to a more profitable route.
Sounds great. Can I kind of recap some of this to you?
Absolutely.
See what we got. So we're working with Canyon Capital Partners, CCP. This is a hedge fund, and it sounds like over the last 2 years they've had a couple problems where profitability is down. And what they want is, first of all, figure out why profitability is down, and second of all, what can we do to actually fix that?
Sounds about right.
Sound good? All right. Do you mind if I ask you a couple questions?
Absolutely.
All right, so first question, I know you mentioned management fees and carried interests. So I've never worked with a hedge fund. Could you give me a little more?
Yeah, absolutely. So hedge funds typically manage their investors' money to generate above market investment returns. CCP only invests in U.S. public equity markets. Management fees, those are fixed fees paid on the average balance of assets under management. CCP's management fees were 2% per year, but were reduced to 1.5% since 2016 because of competitive pressure. With carried interests, that is the share of investment performance appropriated by the fund's managers as additional compensation. CCP takes 20% of all investment gains in excess of the 15% hurdle rate of the year.
Gotcha. So it sounds like management fees is just kind of assets under management times that 2% or the 1.5%, and then carried interest would be 15% threshold, and then anything above that 15% threshold, we keep 20%?
Yes.
All right. And then you kind of answered my question, only investing in U.S. markets. So last question I have for you is kind of what our goal is with this. So are we trying to get back to previous profitability? Are we looking for a directional change?
I think it's more of a directional change. Not so much getting back to what it was previously, but anything to reverse the trend and to increase profitability for the firm.
Gotcha. And any timeline on that?
Not that I know at this time.
ASAP.
Awesome.
Got it. All right. Do you mind if I take a minute to sketch out some ideas?
Absolutely. Take your time. Cool.
All right. I think I've got some ideas. You ready to jump in?
Awesome. Let's see what you have.
All right. So really thinking about this in terms of kind of those revenue streams that you mentioned, and then any additional cost items. So on the revenue stream side, let's first of all talk about management fees. So I'd be interested in knowing kind of our assets under management, in addition to the management fee percentage itself. And what I'd like to know on these is, for the assets under management, how has that changed over the last 2 to 3 years? See if we can kind of locate where a problem might be there. Would also like to get a sense of, for both assets under management and management fee percentage, how does this compare to the competition that we have out there? So get a sense of both of those. Now, for the carried interest, it seems like we need to be looking at, again, threshold, the fee percentage that we take on that excess, and then our actual performance. So again, with these, we'd like to get a sense of how have these changed over the last 2 to 3 years? How do these compare with what competition is doing? And really kind of dig into both of those areas. And finally, I'd like to know on the revenue side, any discounts that we're offering. So I'm imagining maybe we have some high net worth investors where maybe we offered some tier pricing or some tiered discounts just because they're investing more money with us. So get a sense of if that's happening, segment that out into where those tiers actually are, and then what are competition actually doing. So that's the revenue side. On the cost side, I'd be interested in kind of what the major cost drivers are. So I'm imagining this is probably similar to a consulting firm where a lot of the cost is going to be driven by employees. So we'd like to get a sense of what types of employees do we have, kind of segment those out, how many people do we have in each one of those roles, and then what salaries do we have for each one of those. And again, always curious how this might compare with competition. Are we kind of overstaffed versus competition? And then how has this changed over the last however many years, 2 to 3 probably. In addition, just some other costs I'm thinking about, overhead, so things like rent. Also maybe transaction costs, so if we're doing a lot of investing, do we have some transactions and transaction fees with like brokers, things like that. Research, I think, is also potentially another big one. I know Bloomberg terminals are pretty expensive. So is this something where we're spending a lot of money on Bloomberg or some other areas? And then finally, taxes and regulations. So have there been any regulatory, any taxation changes in the last couple of years that have hit us in a negative way? My initial hypothesis on this is going to be, I'm imagining this is going to come from the revenue side. And I'm thinking, since markets are very volatile, I'm thinking maybe there are some performance changes and we're just not performing as well as we have been in the past. And because of that, we're not hitting that threshold, and that's kind of driving down a lot of our profitability.
Awesome. Where do you want to start?
Yeah, well, since the hypothesis is on the revenue side, I think we should start there. So again, looking for some of those things like assets under management, kind of our performance, anything like that.
Yep. So what I can tell you is our asset under management currently is, let me get this right. Currently $2.1 billion. In the past 3 years, the fund has not had any new in or outflows of investor money. So I can tell you that as far as assets under management.
Gotcha. So that must mean that our assets under management change over the last couple of years is based purely on performance of the
I would
fund?
say that's a fair assumption, yes.
Okay.
Other than that, I do have this exhibit for you with regards to the revenue side.
Let's take a look here. All right, so I'm just going to kind of walk you through what I'm seeing, and then there's a lot going on here, so I'm thinking maybe we need to align on a couple things.
Okay.
All right, so on the left-hand side here, I'm seeing assets under management, and it looks like that's associated with the orange component there. And it looks like this is in millions. So we're talking, kind of like you said, 2.1 billion at the high point, and then starting out at 1.5 billion. Okay. On the right-hand side, investment performance. So it looks like we're talking about the kind of blue line right here. Now, my initial thought on this is that this is kind of investment performance at a point in time, but as it seems like that might not be right because we have 0% right here. So that wouldn't make sense that we kind of have 0% performance here and then kind of this massive performance everywhere else. So is it right to assume that this is kind of a cumulative performance line? So maybe we start out from December 2014 to December 2017, and that would be kind of a 25% gain over that entire time period?
I think that's fair to say. I would more or less look at it as the investment performance of that is a snapshot at a moment in time of what the current portfolio was sitting at. So in this case, the fund was opened in December of 2014, meaning they had not received any interest on those investments.
Gotcha.
And then subsequent periods of time, those were the returns on the market that they were seeing at that snapshot in time.
Gotcha. Okay, that makes sense. And then down at the bottom, it just looks like these are kind of the quarters from December to December 2017. Okay, so let's think about what we're trying to accomplish with this. So like we mentioned, we're trying to get revenue numbers out of this and see if revenue has been negatively affected. Do you mind if I write on this?
Oh, absolutely.
Okay, so let's think about what we need and what we're kind of missing at this point. So again, our revenue streams are management fees and then carried interest. And I mean, just to kind of knock this out at the beginning, do we have any discounting or anything like that we need to be concerned about?
I don't think there's any discounting you need to worry about.
So let's mark that one off. That makes this a lot simpler. All right, so management fees, again, we've got assets under management times the fee percent. Okay, and what I'm going to do here, just to kind of make this simple as we go through, is I'm going to divide this into year periods. Okay. Because it seems like that's kind of what you mentioned. Management fees for the first year were 2%, then 1.5, 1.5.
Yep.
So I'd like to divide this into, let's just say December 14 to December 15, and then kind of same thing.
Yeah, that makes sense.
All right, let's do this. I'm just going to draw on this to make it a little bit simpler. All right, so now we've got kind of 3 year periods. I'm going to label this. I'm just going to call this one 2015, 2016, and then 2017. Okay, so what we know here is that the management fee for 2015 is going to be 2%, and then 1.5%, and then 1.5%. Okay, so we've got that. And I think that kind of covers what we need for the management fee portion. So now let's look at the carried interest and just make sure we've got everything there. And then we'll go back and we'll calculate each one of these. Sound like a plan?
Sounds good.
Okay. So for carried interest, I think you mentioned the threshold was 15%. So essentially this is going to be our excess greater than 15%, and then that's going to be times our 20% fee.
Yep.
Okay, so just making sure I understand this. So it looks like our return for this first kind of year period would be 20%, so 0% to 20, so 20% right there.
Yeah, that's a good way to read it.
Okay, and then for December 15 to December 16, again, what I'm thinking, and you can tell me if this isn't lined up with what you're thinking, but I'm thinking starting with 20%, ending up with about 27%, so the return in that year was maybe 7%. Is that kind of the right way to read this?
Yeah, it's the right way to read it. I think 5% would be a good estimate that you could use there.
5%. And then for the last year, it looks like I'm not really seeing much of a change overall.
That would be a fair assumption.
Okay. And this already kind of brings up a big problem because we're seeing these 2 years we didn't actually hit that threshold of 15%. So it looks like for carried interest, we've made $0 in carried interest for these 2016 and 2017, which is not what you want to see.
I would say so.
All right. So let's go back to the first year and I'm going to start with carried interest, and what I want to do is I want to see how much we made in 2015 because we did hit the threshold there, and then that can kind of give us a sense of how much we lost or how much we've reduced carried interest.
Okay.
Sound good? Okay. So if we hit 20%, then that means kind of our excess return would be 5%.
Okay.
So the ER is going to be 5%. So what I want to do for this one is I want to take that 5% excess return. I want to multiply it by, and again, this is an area where you can tell me if I'm on the right track here. I want to multiply it by the starting asset under management for this period. Does that sound right?
Yep.
Okay. So I want to multiply that by the 1,500. And then at that point, I want to take 20% of this value because that would kind of be the excess.
Yes.
that we got. All right.
That sounds about right.
So let's calculate that. All right, so 1,500, we know that 10% of 1,500 would be 150, so half of that would be 75. Okay. And then 20% of 75, well, we know 10% of 75 would be 7.5, so multiply that by 2 would get us to 15. So that means that 15 million would be our carried interest for the 2015 time period.
Okay, yeah, that number makes sense.
Okay, so let me just kind of mark some of this down over here just so we can keep everything in order. So our carried interest is going to be for 2015, it's going to be 15 million. And then 2016, our carried interest is going to be 0, and 2017, our carried interest is going to be 0. All right. Now, just kind of looking at this, I can already tell that this 15 million is going to eclipse whatever we're going to see for the management fees. So if you think we need to calculate the management fees, we can go ahead and do that. But I do think the 15 million, just kind of eyeballing this, is going to be a fair bit higher than what we see in management fees.
Let's go on and look at the total revenue. I'd be very curious to see what the trend is on total.
Yeah, let's take a look. Okay, so if I'm remembering correctly, you said that the management fee is average assets under management. Is that right?
Yes.
Okay, so this might be a little bit tricky, so I'm going to have to eyeball this one. So what I'm thinking is, so we start out with 1,500. And again, you said that all of our AUM increase is based on the performance. So if we're going up 20%, then that means that we're going to be ending at about 1,800. So average in there would be about 1,650. So 1,650, does that sound kind of like the right number? Or?
It's very close. I definitely understand what you're doing. 1,600. Well, I'll use that for just simplicity purposes.
Okay, so let's call it 1,600 right there. And then I'll just do the same for the rest of these just so we can get these numbers out.
Okay.
So we're going to say about a 5% increase on this. So we know that wouldn't be very much at all. I guess for this one, we can say it goes up to about 1,900, so maybe 1,850.
For just consistency purposes, let's just call it 1,800 as well, just so kind of the rounding is the same for every year to mitigate those errors.
And then for this last one, I'm not seeing much of a change at all, so can we call this 1,900?
Yeah, I think that's fair.
Okay. So what we've got, 1,600 average, 1,800, and then 1,900 for each of those 3 years. Okay. So just starting with management fees in 2015, we know the management fee in that year was 2%. So we're just going to take that management fee and multiply it by assets under management, or average assets under management. Okay. So we know that 1% of 1,600 would be 16. So times 2 would be 32.
Okay.
Okay, so we'll call this 32. I'm just going to put that over here. So management fee for 2015 was 32. And again, these are in millions. And then for this next year, we know 1% of 18 is going, or of 1,800 is going to be 18. And then half of that would be 9. So 18 plus 9 is going to get us to 27. Okay, so 27 million. And then the last one here, this one's going to be a little bit trickier. So we've got 19 for the 1%. And then half of 19 would be 9.5. So 19 plus 9.5 is going to equal 28.5.
Okay.
Okay. All right, so let's calculate our total revenues. Okay, so carried interest for 2015 is going to be 15 million plus the 32 million in management fees, which is going to get us up to 47 million for that year. So this is going to kind of be our high water mark. In 2016, we've got 27 million. So that's going to be a change of 20 million, or a decrease of 20 million over that year. And then for 2017, again, 28.5. So that's going to be a decrease of, I think that's about 18.5 million from our 2015 total. So what we can see here, just to kind of tie together this whole page, is it looks like the big heavy hitter in terms of decrease is going to be that carried interest. We've lost about 15 million in revenue in 2016 and 2017 because we haven't hit that threshold. But the management fees also have seen somewhat of a change as well. We saw a 5 million change between 2015 and 2016, and a 3.5 million change from 2015 to 2017.
Okay.
So big heavy hitter here is going to be the carried interest, but management fees also have had some sort of an impact. So what I would like to do, if you have any information on kind of this investment performance, like what's happening, do we know what's happened with kind of the industry or what's happening with our investments?
We actually don't have any information on that available right now.
Okay, so it sounds like we've kind of tapped out on the revenue side. Okay. And if that makes sense to you, I'd like to jump to the cost side.
Sure, what would you like to know?
So kind of looking back at our framework here, like we said, kind of the big cost item that we were thinking about was employees. So do you have any information on maybe employee segmentation, how many we have?
I actually do.
Okay, great. Okay, so let's see here. So it looks like employee headcount and how that's changed over the last 3 years. Okay. So just kind of off the bat here, first question for you is it fair to assume that salaries for these different types of employees have remained consistent across those 3 years?
Yes, it is a fair assumption.
Okay, so salary is good. Okay, so with that said, then, and I guess with salary, does that kind of include bonuses? So we don't need to worry about bonuses, things like that?
Yep, so the compensation is very flat this differs between roles, but there is no really variable compensation you need to worry about in that case.
Gotcha. Okay. So with that said, what I would like to do is to exclude, it seems like this is really just based on count of employees with those two things said. So I'd like to exclude the roles where we haven't seen any actual change in the count of employees.
Okay.
So that would be the C-suite, and I imagine we wouldn't be going after the C-suite anyways.
I think that's a fair assumption.
Okay, so we're going to exclude them. And then the only other one I see is the traders. So it looks like we haven't done anything with the traders.
Okay.
So kind of plan of attack here is I'd like to just forget about 2016 and really look at the change between 2015 and 2017.
Okay.
Is that a fair approach?
I think that's a fair approach.
Okay, so I'm going to forget about 2016. So then the piece that we're missing here is salary. So what I'd like to do is look at the change in the number of employees and just multiply that by salary to see how overall are.
So as you mentioned, we are not going to worry about C-suites and traders, but I do know that portfolio managers make $500,000 a year.
Man.
Associates, $250,000 a year.
Okay.
Analysts, $100,000 a year.
Okay.
And the support staff makes $75,000 a year.
Got it. Okay. So I think we've got what we need to do the calculations here. And again, all I'm going to do is I'm going to look at the change from 2015 to 2017 in the number of employees and multiply that by the actual salary
Sounds
of those
right.
employees. Okay. So portfolio managers, it looks like we saw +1 between 2015 and 2017. Associates, it looks like we saw +9. From 2015 to 2017, analysts, we actually saw -4, so a decrease there, and then support staff, we saw +2. All right, so for portfolio managers, that means that the salary or kind of the wages payable has gone up by 500,000 times 1, or 500K. For associates, it looks like that has been 250,000 times 9, so that would be 2.25 million.
Okay.
That those have went up. For analysts, that decreased by 4, so 4 times 100,000 would be -400,000. And then for support staff, it looks like that went up by 2, so 2 times 75 is +150. Okay, all right. So what I'd like to do now is just add these together and kind of get a sense of how everything has changed. So 500,000 plus the 2.25 million is 2.75 million. Okay. Minus the 400,000 is 2.35 million. And then plus the 150,000 would put us at 2.5 million. So we've seen an increase of 2.5 million over those last 2 years. Again, not insubstantial, but when you compare this to the, what are we looking at here? The $20 million change, the $18.5 million change, we're looking at something that's about 1/8 the impact of what we're seeing on the revenue side. So cost isn't something to be ignored, but again, I think the revenue side seems to be kind of going again with what our hypothesis was, where the big heavy hitting impact is going to be.
Okay.
So let me write down this cost just so we can keep this track. All right, so at this point, it looks like we've covered the revenue side, we've covered the cost side. Just to make sure we've hit everything on the cost side, are there any other cost items that you have? Again, overhead, transaction fees, taxes, things like that?
I know that rents, the fund has made a long-term lease with a minor annual price adjustment, but it's within the realm of error, so I think it's irrelevant to this analysis.
Okay. So based on that, is it fair to say that we've kind of covered all the information that you think we should cover up to this point?
I think so.
right, yeah.
Based off that, what would you recommend?
Yeah. So let's kind of go back to the two questions we had here. So first question, what are the problems? Like we've discussed here, the problems are twofold, revenue and cost. So on the revenue side, our problem is going to be a $15 million loss on the carried interest side. And then on the management fees, we're seeing somewhere between a $5 and a $3.5 million cost or loss. So overall, $20 to $18.5 million is being lost on the revenue side. And then on the cost side, based on those kind of inflated number of employees, we're seeing an increase in costs of $2.5 million. So what should we do about it? Again, going back to where the biggest issue lies with carried interest, what I would recommend is to focus on improving that performance fee or the performance of the actual fund, because not hitting the threshold is what's really kind of driving the negative impact. So I'd be looking at things like machine learning, maybe changing our investment focus, things like that. Now this does come with risks. So anytime you change your investment focus, the partners or the investors could be nervous. They bought in with one sort of investment focus, now you're changing it. So you might see some cash outflows. Secondly, you might not perform very well if you change this. So those are kind of the two major risks that I'm seeing. Next steps then would be, first of all, craft some sort of messaging to your investors, give them a sense of what you're doing, why you're doing it, so they can be comfortable and so you can try to limit those cash outflows. And secondly, I'd be starting to investigate what sort of talent do we need and what sort of alternative strategies we could be investing in to boost up that performance.
Awesome. Well, that sounds great. Thank you so much for your recommendations, and I appreciate your time.
Thank you.
All right.